All right. We often come up with the valuation matrix of how we would value stuff. This is based on my knowledge that I have in like various valuation metrics. There are two ways to value something. One is uh, the present value of the future cash flow, and the other is a multiple-based valuation. These are the valuation technique that I'm going to talk about here. One is MV, which is market value. That's based more on the supply and demand. The other is valuation based on point in time. And then we'll look at two valuation metrics. Then we'll look at how supply and demand changes the valuation. And then we'll look at the Pareto rule. So a lot of this is based on the market and the valuation in which the market decides something. So I'm going to show you an example on this. These are the two valuation for the two cases that we are looking at. Now the two cases hit their peak on the top here, but there is a rate of change of curvature where the steep, so here it goes down the valuation after some time in point, and then here it's like going the fastest. Therefore, this is called like the point of no return. Because at this point, that's just the reverse for the blue chart where it goes up so quickly that you don't get a chance to catch up. If the stock price or the pricing goes up very quickly and you don't catch it and you don't use it, then you are doomed. Likewise, if the stock price goes down too quickly, you cannot catch it. So this is like, therefore this figure is very important at this point. I took my case. So if I'm here in like the peak world or like a little down, then I could go here, which is the peak world here. So this is the valuation metric that I've been talking about. Now, this is given coming from a lot of psychology books. So it's not me. This is given almost all the literature agree for that. Another literature that you want to check out on NY Times is this idea, the probabilities. Everything is a probability. If you're taking a case of a default or anything happening, it's about probability. And when the probabilities become insane, in this case, it's like 2.5%. So that's like uh, less chances of dying in corona rather than getting what you do. Now, the valuation metric on which point and which investor you are talking to changes very quickly. Now, on one side of the equation, when two people are bargaining based on the kind of investment they want to put in, on here on the left hand side, it's mostly this metric, the 50%, the blue metric. On the right hand side, it's just the quick return. So one is looking for short-term returns and the other is looking for a long-term return. Here it's more of a long-term return. Here is a short-term return and this is an ultra short-term return. So it's short-term and ultra short-term. This is long-term, and a lot of this is wit, because you want to be with the smart person, not witless. But more or less, you should understand this dynamics. Again, the same thing. Here, it's a short-term return. That's the valuation metric when you sit on the table to value, and here is the long-term return. Here it's more about a long-term thing and very interesting and deep valuation that goes inside here. Okay, all the market is decided, all the valuations are decided based on supply and demand. If there is an oversupply of any commodity in the market, the prices are going to go down. Now, if the supply peaks maximum here, this is the point when it becomes the hardest, and the supply goes minimum here. So this is the point where the blue or the green chart supplies more. So after this point is the point of no return. But after that, crazy things happen. So although we have seen that the other point is somewhere here, but after this point, it's like really crazy, and this point is really crazy because of some other reason. So, so really, this is the point where you are at the best. But other than that, we have other chance to show that. Now that's why the way in which you do the presentation and market your stuff becomes very important. That's why marketing is, I would say, the most critical part of the business or any investment that you want to look at. The same product marketed in a different way would means a different thing, and the shoes are very nice, I would say. So, and this is about green and red, two kind of products that you want to pitch into. Now, these two products have a different way of doing stuff. Now, the green product moves in a particular line where it peaks, both are parallel, so peak at the same time. But when you are here at this point, this is W1 and this is W2. After W1, you cannot go on the green, so you should forget the green. After W2, you cannot go on the blue trajectory. So after the W2, you are here, you won't have a matching point. So the point where you have a chance to jump on the green line is this, because after this there is no green point on the right. Here you can still go back, but it's going to be on the left. It's not going to be on the right. But after you are here, like after you are here, you cannot do anything. Well, I mean, this is W1 and W2. So if you are here, you can probably go this one. You cannot go on the right side, but you have to move. So which is quite strange, because the gap here would be like 8 units. So that is like, this is like catching the green line, and this is like catching the blue line. If you pass W2, then you cannot even catch the blue line. This is another chart, and I've shown my example. So at this point, I draw this, I draw this. This point, this chart says that there is a 5 units lag that is depicted. So if I do it here, it's like a 5-unit lag. Now this is Pareto rule. It means that 80% of the effect comes from 20% of the causes. This is very important in any kind of engineering system that you make, because uh, all of the things that are happening, like most of it, whether it's delay in project, whether it's low valuation, whether it's quality problems, all of them result from 20% of the causes. So if you can find out the right 20, then you would go. And this is what I mean by that. So these 20%, and these are like 4 points, so I would say 40%, but I would say these 20%, the top two, they are having an effect, or they are impacting like 80% of the stuff. And this is a regulated market, and this is a free market. In free market, uh, there is a free trading, and people are going to go, and it's going to be like 80-20 rule. So the 80-20 rule says that 80% of the effect, it is on the left, is going to 20% on the top, and the other impact is these points are like worthless. I would say a lot of this thing comes on the survival thing as well. We want the best products to survive in free markets, the most economic, the most efficient one. So whoever is going to price it wrong is going to go off. So these products would go completely extinct. The next point is, if you are here, it's like 2 notch down. So if you are here, then the free markets would bring in 2 notch down. Again, we have 2 dimensions to this. We have the blue line and the green line based on how you play it. So otherwise, if you keep everything same, or if you talk about the general, then it's like 3 notch on the left. And this is again a problem about the perception. When you are an owner of a startup, you always perceive your company or your valuation to be higher than what you expect it to be. The notch comes out to be 1 unit. While we would perceive our investment as like a not so good investment. So there is a notch 1. Therefore, when I say that when you are at a unit and you want to find the thing, then if you are perceiving your investment at like rating it high, and if you're rating it low because you're more conservative, then you have to jump 1 up. So if you think it's 8, your investment and your assets, it's much better than that. And then it's like a distance of 2 units, but you already know that these guys are overpriced, so you have to come down. So therefore, if you start from here, you have to go one up, two down, and one down. So it's like 3 notches down. So it's like they say two, but ideally speaking, if you look at the idea about the perception, then it's three. So if you start from here, one, two, three, that's how it's going to work. Now this is still in the radar, but beyond the point, because of the Pareto rule, 80% of the things that 80% of the products or the tweaks that you can do or the availability of stuff, it does not really matter. So I hope this was useful. I tried to be as technical as I can, and I hope you'll find it some thought-provoking.